Like Dill had explained, the bookkeeper gets the trial balance and general ledger in place, and then the accountants come in and do all the adjusting journal entries. The abbreviation for adjusting journal entries is AJE. So you'll see AJE a lot through the presentation. I just realized we didn't put that in brackets to let you know. So AJE is adjusting journal entries, and those are all the write-offs that accountants do to add to what bookkeeping has already been done, all those day-to-day things. Anything that didn't go through the bank or additional write-offs plus taxes, we'll go through all of those. So the main ones we'll go through is accounts payable. So, and we'll explain what that is, but that's part of accrual accounting versus cash accounting. And then we'll go through the gray areas, like the business expenses that, or they're not 100% business, they're not 100% personal. So there's a bit of a split, and they might have not gone through the bank, or they might have not gone through the bank account of the business. They're going through your personal bank accounts, like home office and vehicle. And then we'll talk about loan balances and interest, taxes, that's the big one. And other accruals, those would be things like you receive a deposit for work that you haven't done yet. That would be like unearned revenue or deposit, so that's actually a liability at year end. Or maybe you've prepaid your insurance for the year, or you've prepaid rent, or you have a damage deposit with your landlord that that could just sit there until you move out. There's lots of things that just sit on the balance sheet as assets or liabilities that are considered accruals. So there's various different types of accruals. We won't get too deep into too many of them, but the one that everybody asks about is the shareholder loan and how that works. So some of the examples we have affect shareholder loan, and really that just means the owner of the business. In a small business, it might be business partners or a couple or a single person, but there's usually like startup costs or just business costs that the owner has paid personally over the years and grows that balance up. And so we'll talk about how that moves. So the first adjusting journal entry that we would consider is accounts payable. So here's an example. Your year end is January 31st. On January 29th, your lawyer sends you an invoice for $1,800 for hours worked during January. The invoice is due a month later, so February 28th, which is into the next fiscal year or financial year. But the expense was basically, it relates to work done in January, you pay it in February. So it didn't go through your bank account, and so it didn't get captured in the bookkeeping. It's not in the general ledger quite yet. So we have to put it there because you know you owe that money on January 31st. So that's an example of an accrual. So the debit, like all these adjusting journal entries are in the format of debit and credit. That's just the like two-sided bookkeeping. Yeah, so the debit would be your increasing professional fees expense for $1,800, and the credit is you're increasing the accounts payable line item on the balance sheet. And so we'll see how that adjustment looks on the trial balance after we go through a few of these examples. But in this one, yeah, February 20th, you pay it, then you reverse the accounts payable entry, and your cash is decreased. So you pay it, cash goes down $1,800, and you can clear out that accounts payable liability on your balance sheet. Another example is these gray areas. So business expenses paid personally. So gray areas aren't 100% business, they're not 100% personal, and like a knowledgeable accountant really has to apply professional judgment to recommend a reasonable split on this. Home office is a great example. It's based on square footage of your home office, which has to be like dedicated office space. So usually it's like a bedroom. It's easy if it's like a 10 by 10 bedroom, so 100 square feet, and your house is 1,000 square feet. Then you get 10%, you get to write off 10% of your rent, or if you own the house, mortgage interest, utilities, property tax, insurance. Another one is cell phone. Most people just have one cell phone, and it's going to be, I guess the use varies, how much is business and how much is personal, but typically most people use it for both. Like everybody would love it to be 100% business, but they're still going to sometimes have their like hockey pool or text their friends, text their wife, or kids, whatever it is. So there's going to be some sort of business and personal split. Same with home internet. A lot of accountants would lump home internet in with home office and only take it at the 10% split. But most people, especially during COVID, having that home internet is absolutely critical to running a business. So I think it's very reasonable to have a 50-50 split on that home internet. And then vehicle expense, unless the company owns the vehicle. I guess even if they do, there's going to be a personal use portion, which is like a taxable benefit. So you'd have to do the adjusting entry the other way. In this example, it's the business owner using their personally owned vehicle, and then we just calculate $1 per kilometer. We use 58 cents a kilometer in this example. It's actually gone up to 59 now. But so these are the adjustments we want to do in this adjusting entry.
And just to add on top of that, it's another example of the bookkeeping isn't going to capture these. These aren't running through the company statements. These are stuff you're paying personally, but you want to claim the expense for and get the credit from your shareholder loan. You want to repay that to yourself tax-free. So it's oftentimes not found in the bookkeeping when the bookkeeping's done, and it requires additional calculations, professional judgment, and then recording some adjustment entries to make sure the business gets maximum write-offs.
Yeah, it's a big value add that accountants do is we scrounge up all those write-offs that might have been left out otherwise. So we want to maximize all your write-offs and minimize your taxes. So this is a template that we use with our clients, and it's just to capture all the costs, like your utility bills. I just use some simple, like the average amounts over the year. So insurance, $90, heat and electricity, averaging $260 a month. Your mortgage interest, that's the big one. It's not your full mortgage payment. So you might pay $2,000 a month, but that's not all interest. You're paying down some principal in most cases. So you want to look at your mortgage statement to get that interest number on how much you paid. And then property taxes. So you sum up all those, your total cost of living, $16,300. 10% is for business based on square footage. And so you get $1,630 for your home office. That's a business expense, and your business can pay you back that money, and that's tax-free. So we're going to add the internet and cell phone portion to just the office expense category. And so we're taking 50% of internet and 50% of cell phone. And so that's another $1,200. So we add $1,630 and $1,200 to get the $2,830. That's, you can see in this journal entry, debit office expenses, so we're increasing office expense in the company, $2,830. And then the other side of that amount is in that due to shareholder, because you personally are paying for all those expenses. So now you're getting credit. The company can pay you that back, and it's not taxable income. And then we have the vehicle calculation, which is, we've simplified it a lot. 3,880 kilometers were driven for business. This business owner had used MileIQ to track all their trips. There wasn't a lot in this year because of COVID. They worked from home a lot. Usually that number would be 15,000 kilometers. But yeah, pretty parked at home during this year. So 3,880 times 58 cents is just $2,250. Pretty simple. The business gets the deduction of $2,250, and then they repay that to the shareholder the same amount. So this is the entry for this gray areas. So this credit to shareholder loan increases the amount payable back to the shareholder. And when it's repaid, it's not income, and therefore it's not taxable.
Okay, so for loan balance and interest, as we chatted about, there's the difference between the bookkeeper, what they do, and what the actual accountant does. So accountant would actually look at the mortgage balance And even though the bookkeeper may have recorded it as a full amount of $67,270, the accountant looks at it and says, okay, some of that has to move over and has to be an interest expense. What is important is to understand that moving a portion of that liability and moving it into an income statement as an expense, that's a part of the job of the accountant. And those big changes that happen between the bookkeeper and the accountant, we'll talk about at the end, but there's a lot of adjusting journal entries that they go through, and it takes the trial balance that we talked about and makes an adjusted trial balance.
This is not just mortgage, any loans, any lines of credit, anything that has interest mixed with principal. What we see most often when we get bookkeeping from a client or from another bookkeeper, if you don't know, it's easier just you see that payment to TD Bank or BMO or ATB, and you just put it against the loan. You're paying down the loan, but then it doesn't match the statement at the end of the year because the interest wasn't accounted for each and every time. So it's another common one you see with the adjusting entries, and you see us doing, see accountants doing.
We'll come back to this actually. Okay. So anything else to say about this entry? Okay, we'll move on to taxes. Okay, this is the big one. This is like where the accountants are basically taking the bookkeeping and calculating the taxes. And there's these few steps to make sure you're getting all the write-offs before you do the tax return. So yeah, you want to make sure you've captured everything you're going to in terms of write-offs and extra revenue or whatever. You want to make sure all that's adjusted for before you start the tax return. And then you complete the tax return to get two numbers, the income tax expense as well as the income tax payable, because they're not always the same. The expense is the 11% of your profit during the 12 months. And that's basically what the company owes on that profit. For the tax payable, there might be some like losses carried forward or a refundable portion of tax that we don't need to get into that piece of it. Or just you might have made your installments during the year or had a refund last year that you just applied to installments this year. So there's a few things that can cause the two to not exactly line up. Plus there's the federal and Alberta portions. So this is like the T2 summary from the tax software we use. And this is what gets generated and summarizes everything we've done in the tax return. So we put in the full income statement, and then this is the net income and then there's the taxable income. There's no adjustments there. Sometimes these are different. But federal tax owing is 11,133. What's not showing on this is the Alberta income tax owing, which is the 2480. But the 11,133 plus the 2480 is the full $13,000 tax expense, but we've made tax installments of $6,600. So these two amounts are the tax owing for the January 31st year end.
It's a complicated one. It's difficult to explain, but Matt's got it laid out here pretty good.
Yeah, I did want to just show this one here. So this trial balance, this is what the bookkeeper had done. And so during the year, 6616 was tax installments made throughout the year. And so that the bookkeeper put to income tax expense. Now we did the tax return. We've calculated the full tax expense is going to be 1361. So we just add the 6997. And then these two entries here are the amounts that still need to be paid.
And just to highlight the difference, like the opening balance is on the left under the bookkeeper column. Like oftentimes until all the adjustments are done, you can see the adjustments in the middle column. So the left side column under bookkeeper, like it has the change in motor vehicle office, professional fees, interest, income tax expense, and the difference in the shareholder account and the mortgage payable, like the change after all the adjusting entries are done, can be really significant. Like it can mean the difference between correct and not correct at the end of the day. Or you give your financial statements to a bank and they see liabilities that don't even exist, or they're recorded at the wrong amounts, or you're paying too much tax because your write-offs are not captured. So it's a good way. This is a really good illustration of how much can change just from 4 adjusting entries, 4 common adjusting entries, not to count so many others that potentially could be there too.
Yeah, and look at how many of those adjusting entries are additional expenses to the business that wouldn't have been captured otherwise. Motor vehicle, office, that lawyer bill, and the interest. So that's just reducing the amount of tax you owe. So yeah, here's the entry that just kind of trues up that tax owing after the installments. So income tax expense, $13,613, which is essentially 11% of the net income or taxable income. But federal installments were paid. So that 13,000 is made up of Alberta and federal, 9% and 2%. But the installments were just going against the federal portion. We don't need to dwell on this too much, but yeah, that's a summary of taxes, and then this is a summary of the 4 entries we made. And every entry, again, has 2 sides, a debit and a credit, and they have to equal. And sometimes, like generally, if you look at all these, it's one entry, like the debits are all hitting the income statement, and the credits are all hitting the balance sheet. So there's always that 2-sided effect. Like when you say you go to Home Depot and buy a 2x4, your 2x4 expense account, supplies or materials, that goes up by how much is the 2x4 these days? Like $27. So yeah, your 2x4 expense goes up, but your cash or your credit card balance changes on the other end. So there's always 2 effects that are happening. Okay, so and then this is just like a snapshot of which accounts on the trial balance are affected, but here's the full. I know this is blurry and small, so we don't need to you don't actually need to see all of this, but this is this first column here, as Curtis mentioned, this is what was prepared by the bookkeeper, and then these are the adjustments we just made. So this, this is the adjusted trial balance, which just maximizes all the write-offs, moves some things around. And next, we turn it into financial statements.